All right, so let's get started. Welcome to our home buying workshop. We're pleased to have you here today. So for those of you that are not familiar with a credit union, I'd like to give a brief introduction. Credit unions provide not-for-profit banking products, loans, and services. We are owned by our members who have a say in how the credit union is led and operated. Every member is an owner, so it's a democratically controlled financial institution, where members vote on the board of directors and have a say in how the credit union is run. And we are for people, not for profit. And this is an overview of how credit unions work. So when you deposit money with a credit union, we use it to make low interest loans to fellow members. Profits made off of the loans are put back into the credit union and returned to you as better rates and fewer fees. Denver Community Credit Union has served Metro Denver since 1934. This class is part of our free award-winning Clear Money program, a financial education program that includes live classes, coaching, and e-learning courses that are available on our website in English or Spanish. Our one-on-one financial coaching is available via Zoom or phone to answer your personal finance questions and help you reach your savings, budgeting, credit, and other goals. You can request a coaching session at denvercommunity.coop/coaching. And we'll get in touch with you to schedule a time. And these are your presenters today. So the first presenter is myself, Sarah Kurth. I'm the Outreach Program Director at Denver Community Credit Union. And I am joined by Irene, who I'll have introduce herself and share a brief biography.
Hi, everybody. Good to have you all here. Welcome to our class. I'm a realtor broker with Live Urban Real Estate. I've been doing residential real estate brokerage for the last about 20 years. And I'm excited to be here to share with you information about how to go about the process of buying a home, as well as a little bit of information about the real estate market trends currently.
Thanks, Irene. So home buying is one of the biggest purchases you'll ever make. I don't need to tell you that. But it's a process with many reassuring steps, and there are many tools out there to help. So if you could take a moment and share why you are interested in buying a home in the chat box. All right, so there are many reasons, and I will turn it over to Irene.
Okay, so home ownership, as you guys might be aware, has a lot of upsides. And so Sarah has listed some of these here. There's stability in it. You don't have to move all of the time. When you're a renter, you're kind of at the mercy of your landlord. And it's not on your terms. When you're a homeowner, everything happens on your terms. Also, there's appreciation on your investment, which, as you guys probably have seen in the Denver market, has been quite a bit in recent years. We've seen double-digit appreciation rates. And with home ownership, the investment is just such a great opportunity. With a down payment as little as 3%, you can buy yourself an asset. What other way is there to buy an asset that costs $400,000 with a small down payment? Well, it's not necessarily small for everyone, but about 14% down is a 3% down payment on 400,000. So it's really a way to start gaining wealth and making really smart financial decisions. When you're renting, you're really just losing money every month. If you're paying about $1,500 a month, if you multiply that out yearly, you're looking at a year of $15,000 to $20,000 for that year, and you don't get that back. Whereas with a home ownership, you eventually do when you go to sell or refinance. I like what everyone's putting into the chat about why it's important. Rents are outrageous. You're right, and ownership is just, it's really important. It's a financial stepping stone for everybody to be able to start gaining wealth and hopefully get some generational wealth. And it really is just a first step. And you get to pick things like your own backyard, and your rent won't keep going up. And sometimes your mortgage payment can actually go down if interest rates go down, if you refinance. So there's just a plethora of benefits I can't stress enough. And I know that you guys are here because you understand that. So congratulations on taking that first step. Someone's asking me which area I'm a realtor in, and I work in, my company is Live Urban, and we focus on the Denver metro market. But these days, with the very small inventory, we have been branching out and going out into the suburbs. So I work everywhere in the 7 metro counties, including Parker and all the way down to Highlands Ranch and all the way up north to Thornton and beyond. So all of the Denver metro counties. Right now, I have a listing in Brighton for the first time. So definitely branching out because we have so few listings right now. So I can help you guys if you need it in any of those Denver metro area. All right, should we flip the slide to the next one? So as far as home ownership, it's obviously a little bit different than renting. There's different responsibilities. When you are an owner, when you're renting, your landlord fixes things. There's no property taxes and no homeowners insurance and no maintenance costs. But for all that, obviously you're paying rent. It is expensive in Denver. As I said, if you're around $1,500 a year, that's about $1,500 a month. It's about $18,000 a year. Over 5 years, you're looking at around $90,000. When you're an owner, you do have to fix things when they come up. You do pay property taxes and your insurance. A lot of times people do have those escrowed within their mortgage so that you don't have to necessarily come up with a large chunk during those times when those are due. You do have to maintain the property and the land, which a lot of times is really great for most people who take real pride in that. And so it's just really a different mindset, and hopefully you guys understand, and I'm sure that you're here because you understand that the benefits of the owning. So even though there comes lots of responsibilities, there's also great privilege and great things that happen when you are an owner. So one things to think about: is home ownership really right for you? Are you someone who does have that homeowner mentality, or do you prefer to rent? Do you not want to take the risk of having to fix things? And would you rather just call a landlord to do those things, or are you someone who does have that ownership mindset and is ready to take that step? And are you an optimist, really? Do you believe in the value of home ownership? These are all good questions, I think, to ask yourself and really think about. And then the next step is really to think about and determine what you can afford. It's a really good idea to come up with your budget and think about what your regular expenses are, your car payments, if you have that, school, education loans, any credit card debt that you may have. Write all those things down. It's helpful to do a spreadsheet and determine what are you paying for rent now and how much home can you afford. And there's people who can help you with that. Your lender, trusted advisor, Denver Community, they probably have worksheets and things that can help you out with budgets. And there's lots of classes and resources available about that. Then the next thing, really, if you decide that homeownership is right for you, then the next step is really to get pre-approved. Talk to your lender, whoever you're going to use, and get them all the documentation that they're needing in order to get that pre-approval process going. It's really important to be pre-approved before you start looking at homes. And then also it's really important to have a down payment and figure out where that's coming from. So the different ways to do that are you can save for a down payment. Obviously, that can be very daunting in today's market because prices have gone up so much. And it can also be a gift from your family member, or alternatively, there are programs out there that help with down payment assistance. So you can dig into those and try to find one of those. And I know that right now there's talk about helping out first-time home buyers, and there's some bills on the way in legislation that I think will help with down payment assistance for first-time home buyers. Make sure that you select a great lender, somebody who is going to be your trusted advisor. Ask a lot of questions. Make sure that they have great customer service skills, they're reliable, that they're going to deliver on what they promise. And obviously, Denver community has been in business for a long time and have some great resources for you. So talk to them first. Then also you're going to want to select your real estate agent, and the real estate agent and the lender work hand in hand, and they're your trusted team. So make sure that you have people that are really good and that you trust. And like I said, ask a lot of questions. There's some great resources out there about what questions to ask. Sarah, I think we have those in some packets that we're providing to folks. Is that correct?
We do, yeah. So everyone who registered for the class will receive a resource email that will include a guide that includes those questions.
Great. Yeah. And, just you really want to be comfortable with both of the people on your team because you're going to be working with them quite a bit in the process, and which can take anywhere from 30 days on out to, I've got clients that I've been working with for much longer than that. But so you want to make sure it's somebody who's really comfortable, who's available to you, who's got great skills, negotiation skills, as well as people skills, and just really find out what their strengths are and make sure that they match yours and your personality and what you're seeking. So go ahead. Sorry.
Did you want to add anything, Irene?
Nope. I think I'm good. I see that next slide there.
Okay. So how much can you afford? The standard rule is that housing costs shouldn't exceed 35% of your monthly gross income. So gross income is the income that you earn prior to taxes, health insurance, and those other items being removed. And the payment should take into account taxes, insurance, and costs that include PMI and HOA. There are a lot of acronyms in real estate and mortgages. PMI is private mortgage insurance. It is an extra cost that you have if you don't have a 20% down payment. And for first-time home buyers, 20% down payment is uncommon, even with some people who are not first-time home buyers. So that is something that helps secure your loan and provides some security to your lender that if you default on your loan, meaning that you do not repay it, that insurance helps cover the outstanding balance. An HOA is a homeowners association. Some homes, townhomes have an association that requires dues to keep up neighborhood amenities. And we'll go over an example. So let's say that your household earns $50,000 in a year. You divide that by 12 to find your monthly income, which is about $4,100 a month. You multiply that by 0.35, so 35%, and that gives you the 35% of your gross monthly income. And we have a chart on the side that shows examples by varying incomes. Here's an example of a home that sells for $300,000. So with a down payment of 5%, that would amount to $15,000. And let's say that the interest rate is 4.25 APR. APR is annual percentage rate. That is the best way to compare the cost of mortgages. The loans themselves is looking at the APR, because the APR doesn't take into account just the interest rate. It also includes any fees that may be wrapped into the loan. And this is not our current rate. Rates are really, really low right now, and typically lower than this. And if you're curious about current rates, you can go to lenders' websites, including our own, to find the most up-to-date information. So in this example, the payment for a mortgage would be $285,000, which would amount to $1,400 a month. And it's $285,000 because it takes into account that $15,000 down payment. So the purchase price is not typically the loan amount, unless you have a special mortgage, such as a VA loan that requires $0 down. You want to add taxes, insurance, PMI, and HOA to the cost of the total housing expenses that you'll have. And typically your housing costs and other debt obligations should be less than 43% of your gross income. So that could be student loan monthly payments, auto loans, minimum balances on credit cards, personal loans, equipment, or business loans that you may have that are in your name. All of those would be taken into account. And there are special home buying programs for first-time home buyers through FHA, which is a federal lending, veterans, so the VA, Veterans Affairs, and adjustable rate mortgages exist as well, where you do not have a fixed rate the entire duration of the loan. It might start off at a low rate and then go up over time. So putting 20% down, so a 20% down payment based on the purchase price is what avoids that PMI, that private mortgage insurance. And as I mentioned, it is unusual for first-time home buyers. Without 20% down, you often have to pay the PMI. But hopefully your home will increase in value and you can hit that 20% sooner in equity. So equity is the amount of your home that you own. And you'll see what 20% down looks like based on the home value on the right. And now we'll go over some home buying loan options that are available from most lenders. So conventional mortgage loans are underwritten and insured by private lenders and investors. So this could be credit unions, banks, and other mortgage lenders. Down payments can be as low as 3% for qualifying first-time home buyers, but they're more commonly 5% minimum for other borrowers. No mortgage insurance is required for down payments of 20% or higher typically, and buyers with higher credit scores and good down payments typically benefit the most from these types of loans. Typically, the higher your credit score is, you qualify for the best rates, so the lowest APRs. And as I mentioned, it's really helpful to compare when you're looking at the cost of mortgages, looking at the APR as opposed to just the interest rate, because the interest rate can be deceptive if there are a lot of fees that are tacked on. That was my experience when I was shopping for a mortgage. And I would see these really enticing rates that were really, really low. But then when you look at the APR, which takes into account any fees that might be bundled into the loan, it bumped that rate way up. Some government loans include additional fees or mortgage insurance requirements that conventional loans don't. Private lenders set their own fees, which is why it's really helpful to shop around and see what's out there. Credit unions typically tend to have really great rates because they're not for profit. Requirements are stricter for these loans because they're not backed or insured by the federal government like an FHA loan. So conventional mortgages put lenders at risk if a borrower defaults, meaning they don't repay the loan. And then we will discuss FHA mortgage loans. So FHA, another acronym, stands for the Federal Housing Administration. Most loans are limited to about 484,000, but it varies by county. So counties where the cost of homes is lower would be capped lower. In Denver, that's around what the cap is. Upfront mortgage insurance is usually required over the life of the loan. Typically, it's 1% of the cost of the loan. So in a conventional mortgage, which we talked about earlier, you have that PMI of 20%. But when you hit 20%, you own 20, you've invested, have equity in 20% of your home, you can request to remove that private mortgage insurance, and that's no longer an expense that you have. And FHA loans, it's bundled into your loan and you can't get rid of it later unless you refinance, take out a new loan to pay off that loan. And that's the way that you would get rid of that upfront mortgage insurance. So it's non-cancelable. Borrower is not required to be a first-time home buyer, but you must have not owned a home in the past 3 years. Gifts and grants are permitted. So Irene touched on this earlier. That can be a source of your funds for down payments and closing costs. And non-occupant co-borrowers are allowed. So that is a very technical way of saying that somebody who does not live in the home is allowed to co-borrow on the loan. So let's say that I have a low credit score, or I don't have a lot of credit history and I wouldn't qualify for an FHA loan on my own. I could have a co-borrower, a relative, a friend who co-signs on that loan with me, even if they don't live on the property. Some of the benefits are low down payments, typically 3.5%, may be able to buy more house. They can be used for purchasing as well as refinancing, and less cash on hand may be required. VA mortgage loans are specifically for veterans. So VA stands for Veterans Affairs, and they're for veterans who served 90 consecutive days during wartime or 180 during peacetime, or 6 years in the reserves minimum. If eligible, a VA mortgage loan allows you to purchase a home with no money down and no mortgage insurance, which is a great benefit for veterans. It can be an excellent alternative. The VA does have some strict requirements on the type of home you can purchase, so it must be your primary residence. So if I were a veteran who qualified, I wouldn't be able to buy an investment property or a beach house that I plan on renting out on Airbnb, for example. And the home must meet minimum property requirements. So no fixer-uppers are allowed. And by fixer-uppers, I mean the house has to be livable. So it can be a home that you buy that you want to upgrade. That's totally fine. But if it's unfinished, it doesn't have plumbing, for example, that wouldn't qualify for a VA loan. And there are some great local nonprofit resources for homeowners out there. CHFA, the Colorado Housing and Finance Authority, has home purchase loans that include education requirements. They offer free home buying workshops that qualify for HUD. So if you're planning on getting an FHA loan, you will have to take a home buying workshop that is a lot more extensive than this one, and have that education requirement within a year of applying for the loan and closing. They offer those workshops that are also available in Spanish. They also have grants and loans for down payment and closing cost assistance. There are some income limits for those typically. They have low income rental housing and foreclosure prevention resources. And Colorado Housing Connect is a great nonprofit as well. So they are a hub where you can be connected to many local and statewide resources that are specifically for homeowners, home buyers, and renters. So it'll connect you to those free resources, nonprofits, government agencies that are related to home ownership, renting. That can even be landlord-tenant disputes, eviction help, preventing foreclosure, just general counseling about home ownership. They help seniors and people with disabilities with home repairs and maintenance. They help with fair housing issues, so housing discrimination issues, and affordable housing. And these are some good tips when going through the mortgage process. So A good rule is to keep in constant contact with your lender since they are key to getting your home. It can take some time to find a home in Denver. There are homes out there, of course, but it's competitive. So it may be the case that you need to submit your documentation more than once, because after a certain number of days, you have to reprovide your pay stubs and updated banking information. So you want to continue to do that and send those banking stubs, payment information throughout the process. Deliver all of your documents when your lender requests by the deadlines so that your mortgage, your pre-approval remains updated and valid. And some things to avoid would be not incurring new debt. So sometimes this is unavoidable. So, if I total my car and I need it for work, I may need to get a new car loan or something like that. But otherwise, I do not recommend, if you can avoid it, taking on new debt, because that'll impact your approval amount. So your credit score is a factor, but so is the amount of debt that you already have, which we mentioned earlier. So if you take on new debt, it may lower the amount that you qualify for a mortgage. I worked with somebody who spent years preparing for homeownership, and then they got a credit card to a furniture store and started buying furniture for their home that they didn't close on yet. And then the deal fell through because they didn't qualify for that larger mortgage amount anymore, because they took on tens of thousands of dollars of debt for furniture for a home that they hadn't secured yet. So you just want to be really careful. It's an exciting time, and it's great to want to be prepared and get those items lined up for your house, but just wait till the deal is done. Avoid changing jobs. And by changing jobs, I mean changing professions. So if you get a promotion, that's awesome. But if you completely change your line of work, you may have to prove that you have stable income over a certain period of time. So right now I work in community outreach, education. If I suddenly quit my job to become a basket weaver, I would not probably continue to qualify for my mortgage, because I'd have to prove that I can support myself as a basket weaver, earning enough income to repay the mortgage over the course of a couple of years. And avoid making changes to your credit in general that can impact your loan. So keeping your credit card balances low, kind of keeping things as you had them, or improving your credit throughout the process is really recommended. So something that impacts your credit is the percentage of the limit that you're using. So if I'm keeping my balances low and all of a sudden I start doing a lot of spending on my credit cards and I'm maxed out, I'm hitting the limit on all my credit cards, that could impact the interest rate that I'm given or the mortgage approval in general. And closing costs. So these are other costs to consider beyond the down payment. You want to estimate 2% of the purchase price. This doesn't include prepaids such as points. So this was really confusing to me when I was in the home buying process, because I am a accredited financial counselor. I do a lot of financial education, but I'm not a mortgage loan officer myself. If you do have very specific questions, I will absolutely pass those on to our mortgage loan officer, or share your contact info and connect you so that you can get those answers. But prepaids, including points, typically means you pay a lower interest rate, but you pay money up front for the lower rate. So it doesn't include that. 2% is a good estimate. My experience was that it was less than that, but it's better to estimate on the higher end and have it come in lower. The buyer typically pays for the appraisal, so figuring out the value of the home. An inspection is always a good idea. The down payment, earnest money. Earnest money is money that shows that you are being earnest or serious about putting in an offer, and that will really depend on what the seller requests. So I've seen those be $5,000, sometimes more, sometimes less. Irene can speak to that a little better since she's a realtor. But it's typically money that ends up going towards your down payment and closing costs later, but it just shows that you're serious and you're not just writing offers without any skin in the game. And it's important to note that the buyer does not pay the realtor. So the seller pays the realtor for the buyer as well as their own realtor. The seller pays title insurance and then all realtor fees. So typically 3% goes to the buyer's realtor and 3% goes towards the seller's realtor, which adds up to 6%. Both pay closing fees, and there are some other fees that may exist depending on the home itself. So there could be transfer fees for an HOA. There could be flood insurance if you're in a low-lying region, and so forth. Any questions on any of this so far, feel free to pop them in the chat. And as I mentioned earlier, you will be getting a resource email after this class as well. And there will be a button you can click on to submit a question to a mortgage loan officer. All right, I'll turn it over to Irene.
Okay, now that you're pre-approved, which I cannot stress how very important that is that's really where you want to start, is figuring out how much home you can afford, and also your funds available for down payment, and all of those things that Sarah said about keeping your credit in check, and really just focusing on that to get it as high as possible. 760 is kind of the sweet spot. Any credit score above 760, you get better rates. So if you can work on that, of course, there are loan programs available. And with FHA, you don't really need to be at that 760. You can go down to even 690 and still get approved for your mortgage. And I really liked what Sarah was saying about not rocking the boat and not taking out new debt, with the example of her friend who did that with buying furniture. You definitely do not want to do that. And the other thing is really keeping tabs on your bank account so that you're not seeing large influxes of money there either. I've had clients who were saving for a motorcycle under their mattress and then wanted to buy a home with that instead, and so deposited into their bank account. So there's just a lot to think about when you're in the process. You want to make sure that you're not creating waves into your accounts.
Irene, we did get a question about what does pre-approved mean exactly?
Yeah. So pre-qualified and pre-approved, you kind of hear those two terms used in together all the time. Pre-qualified is just basically making a phone call to a lender and saying, these are my debts, these are my assets, and the lender can give you an idea of how much home you can afford. But getting pre-approved is more serious than that, where you actually provide them your documentation with your tax returns, pay stubs, bank statements, and the lender does their due diligence and runs you through their processes so that you can actually get a letter from the lender that says that you're pre-approved. And that's really when you're ready to go look at homes. Until then, you're mostly looking online and getting an idea and a feel for where the market is. I hope
Yeah, absolutely. And they did ask, can you get it before you look at homes? Absolutely. We encourage that. Markets are different in different parts of the country, but in Denver, typically in the Denver metro area, if there's a home that you're interested in, you want to already have your pre-approval letter ready, know what you can afford, and be ready to make an offer sooner than later, because houses don't stay on the market very long. Is that accurate, Irene?
Exactly. In fact, our days on market in Denver is about 4 days. So that's on average. So typically our homes come on the market on a Wednesday and we'll go through the weekend, and most of them do get multiple offers. And then they're under contract by Monday or Tuesday. So it's a little bit challenging, but I also don't want you guys to get discouraged, because there's still people buying and selling homes every day. And hopefully our inventory will increase as the summer months. So you're in a good spot right now, because typically June through the end of the year is when our inventory starts increasing. Actually, June through the fall is when it starts increasing. So it's a good spot right now being in May.
Absolutely. And I'll just add something, Irene, that I found interesting. I've only purchased one home, but the pre-approval letter, I didn't really understand what it would look like, but it's essentially just a letter from your lender So in my case, the credit union that said, she is approved for up to X amount for the loan. And let's say that you are approved for a loan amount that's higher than what you're comfortable taking out, right? You might not want to take out a mortgage for the amount you're approved for, because just because you're approved for an amount doesn't mean you can comfortably make the payments and enjoy other aspects of your life. You don't want to become house poor where every single dollar you earn is feels like it's going towards your house. You may have other goals that you're saving towards, or want to be able to take vacations or furnish that house nicely. So you can have your lender make the letter out to be lower than the maximum you qualify for. Does that make sense, Irene?
Yeah, and I would actually advise people to think about, really shopping way below their limit because of the market that we're in right now. So if you're pre-approved for 400, I would recommend looking in the 300 to 350 range and really topping it there, because unfortunately, our asking prices in the Denver metro areas are not actually the price, because they get driven up by multiple offer situations, especially, in the lower price points. So I would highly recommend looking much lower than what your letter says you're approved for. Does that answer it? Well, we have a question about VA loan requirements. If you meet VA loan requirements but own a home that you want to keep as a rental and plan to live in the new home you purchased, would you still qualify for the VA loan since you would be living in it even though you are keeping your old house?
Ooh, that's a good question.
Yeah.
I'll need to refer that one to a mortgage loan officer. I know VA loans are intended for primary residences. I just don't know, since you already own another property. I would think it depends on the type of mortgage you have on the first property, but as I mentioned, I'm not a mortgage loan officer. So I will find out. The person who asked the question, if you could send Denver Community, the host, or myself, Sarah Kurth Bay, a private message with your email address or phone number, we will get an answer for you and follow up. But yeah, just don't put it into the chat to everyone unless you want everyone to have your contact information.
All right, I think we're ready to move on to the next slide. So once you get pre-approved, and I think we've stressed enough how important that is. Now what? What do we do? And Sarge, you want to flip that? At that point, you're pre-approved. Hopefully you've saved some money for a down payment, and you've worked on your credit. At that point, look around and choose your real estate agent. And you can do that in a variety of ways. You can ask for referrals from friends and family. You can ask for referrals from your lender, your lending institution. You can research people online, ask that person a lot of questions. And like I've stressed before, this is a person that's going to be really important to your team and works really hard for you. As far as choosing an agent, what does a real estate agent really do? We really are your trusted advisor. We guide you through the process. We advise you along the way. We negotiate on your behalf. We prepare contracts for you. Back in the day, it used to be that we would just look for houses, but right now, with all of the tools that you have available online, that's really a small part of what we do. The rest of it really comes into play once we find that house for you, and negotiating, working in your best interests, and then preparing contracts and seeing the deal all the way to closing is really what you need that trusted advisor for. So you probably hear real estate agent, realtor, kind of what's the difference? A real estate agent is somebody who we're all licensed, but a realtor is actually somebody who belongs to the board of realtors and has an ethics requirement and there are classes and continuing ed requirements that we have to meet in order to carry the realtor label. So most of us are realtors, but you might want to ask your real estate agent if they are. As far as who pays an agent, typically that is the seller, like Sarah pointed out. The way that the real estate business works is there's a listing agent typically and a buyer's agent typically. So a listing agent will be somebody who works with the seller. They take the listing, they write up a listing agreement, and then they put the property into our MLS system, which is the system where all properties that are listed by a real estate agent or a realtor go into, and then that syndicates out. So when you're seeing listings on the Zillow sites, the Trulia, and all of the myriad of other sites, those all come from the MLS. And we all get paid on commission only once a transaction closes. And the like we said, that typically is by the seller. Uh, these days, that and 99% of the time it is by the seller. But I do want to say that these days that can be different if there are other realtors that are not offering a full commission. So you'd have to talk to your real estate agent or your realtor and find out how that's going to work. And it can be property dependent. But like I said, in 99% of the cases, it is paid for by the seller. Make sure that you interview that future agent and make sure you're really comfortable with that person and want to work with them. And what makes a good agent, Sarah will pass on some questions for you to ask in your resource guide. Somebody who's going to be available to you, who has experience, who really who cares, who wants to treat this as a relationship, because it's not just a one-time transaction for most of us. It really is a relationship because, being in it for a long period of time, I've been in real estate for about 20 years. It's really about finding the person that first home onto the next one. And is it someone who's going to want to, who does business by referral, so wants to really take care of you so that you will refer them other business, and it's really someone who cares and wants to see good things happen to you and work in your best interests. So setting house priorities, really important to do that. There's going to be a sample list in your packet, and you want to decide what your must-haves are. What are your deal breakers? What are your like to have, or you really do not want to have? Something to really keep in mind is that you don't want to be too picky in this market and too limiting, because unfortunately we only have about 2,200 listings on the market right now, Denver metro wide. And to give you a little bit of a ballpark, in the height of our market in 2007, 2008, we had about 15,000 listings. So it's a pretty big difference. So even though you want to set that priority list, make sure that you stay pretty flexible, keeping the goal in mind that home ownership is really the most important thing. And this really could be just a stepping stone to that next home. And it's your starter home typically. And then after you've set your priorities, I'll go back one, Sarah. We want to make sure that that's okay. You only look at houses that really match that criteria, and be really realistic within your price point. Of course, don't settle for something you're going to be extremely unhappy with. But with the market, just really keeping in mind that the goal is having that first stepping stone. So then going out to view properties. And what, typically most of the first showings happen online now. And there's so many great tools. I'm sure you guys have all seen all the pictures and the virtual tours that we take. And we pick out the best couple, usually between 5 and 6 for that first round to go look at. And it's very helpful when you're going through the house to really communicate with your agent and be really honest with feedback on what's important to you. And we don't live in any one of these houses typically. So you could really be honest and say what works and what doesn't work. And it's helpful for you in your head to really compare them to each other. And at the end of that viewing session to really say, okay, this one really stood out. And maybe you end up writing an offer on that one, or maybe not. Maybe you hold off and see what else comes on the market the following week. Every week it's different. And then maybe, you do need to remain really flexible, because as the market changes week by week, and if something comes on that matches your criteria, you really got to jump on it and go look at it right when it comes on. And then it's sometimes helpful for people to use a checklist for each of the houses to remember what was in it. And sometimes I've had buyers do spreadsheets for themselves, and I'm happy to share those with you guys if they're helpful, to help you decide and narrow down. And try to be really objective with your wants and needs, considering your location and your lifestyle. Location is obviously one of the most important things. Most things, it is the most important thing, actually. Everything else about a home can typically be changed, but location and lot is really the one thing that can't be. So you want to be really honest with your agent and figure out, talk about your lifestyle. Where do you work? Where do you play? Are you working mostly from home now, so it doesn't really matter where you live these days? Or do you have to go into an office and you don't want to have a long commute? All things to really take into consideration.
We did get a question in the chat box about what is a bubble agent. They said, is this when a buyer and seller have the same agents? Does the agent get bubble paid?
Bubble paid. What is a bubble agent? Stephanie mentioned this one. Maybe you're thinking of okay, so maybe you're mentioning a double agent. So I'll say that in the past, long time ago, back before there was the real estate commission who really cracked down on real estate agents. Okay, so you're meaning a double agent. Okay, so there's the listing agent, the buyer's agent, transaction broker. Double agency does not exist anymore, and our real estate commission has not allowed that anymore. But a transaction broker is someone who does what it is when there isn't a buyer's broker involved. So a listing agent takes a listing, they put the property on the market, and if a buyer comes without an agent, then that listing agent has the authority to become a transaction broker. And so the difference between being a transaction broker versus being an agent really means that you're not representing either party. You're being kind of the referee versus the coach in any particular person's corner. I hope that makes sense. The difference, and as far as getting paid, yes, a transaction broker, since we get paid by the listing, by the seller, they do in effect get double paid. They don't have to share that commission with a buyer's agent. It really is in your best interest as a buyer to have a buyer's agent versus just going through the listing broker. Does that make sense? I hope. So yeah, and yeah, go ahead.
I did get one other question in the chat box. For purchasing a home, is having a buyer's agent more advantageous than not having one?
Yes, I firmly believe it is. So like I've mentioned the transaction broker versus buyer agent. Those are the two ways that we're allowed to act on your behalf. And as a buyer's agent, it is a coach, somebody who's in your corner advocating for you and your best interests. As a transaction broker, it's like a referee, and we represent the transaction. We can't advise, we can't advise either party. We just basically lay it out there and try to be, really fair. So that's, kind of that's the difference. And it is in your best interest to get yourself a buyer's agent. And like I said, in most 99% of the time, we do get paid by the seller. So there's no reason not to. Okay.
Thank you.
Yep. So as far as making the offer, and this is a really good slide about what the process is. And there's quite a bit of legalese, and your real estate agent is your experienced ally, and we work really hard to protect your best interests and to advise you and inform and educate you throughout this whole process. Once your offer gets accepted, that is a glorious day these days, and we really celebrate that. And then the work begins up through the closing date. And usually the time period from making an offer to that closing date is about around 30 days, depending on, if the seller lives in the house, and, there's a lot that goes into an offer. There's a lot of dates and deadlines and contingencies that go into the offer. And so some of those are listed here with inspections and appraisals and then final loan approval. Those are contingencies that are within the contract that are really designed to protect the buyer, especially that inspection period. So just going back a little bit, after you do make the offer and it is accepted, that is when you owe earnest money that goes towards your down payment. Sarah talked a little bit about that earnest money, and that gets sent over to the title company. Typically, they hold that earnest money in a trust account, and then it gets applied to your down payment at the end at closing. So it's not money that you lose. It is safe and it is set aside. And typically it's between 1% and 2%. So you do want to make sure that you have, if you're looking for a house that's about 400,000, that is, $4,000 to $8,000 that you want to have on hand, that you'll be able to write a check for to the title company and have it held. And it's your good faith money, saying that you are a real buyer and you have skin in the game, and that you are planning on going through the transaction. And in the contract, then you've got your inspection objection period, which usually is about 7 to 10 days after going under contract. The seller wants that to happen really quickly. Because it is, as a buyer, you're pretty well protected within the contract until that period, because you can object for any reason. As a buyer, for any reason, you can object to the house, and you might terminate the contract and get your earnest money back. In this market, with how difficult it is to get under contract, some buyers are waiving inspection objections. I would never recommend a client to do that. But sometimes we do limit inspections to only health and safety things. And this would be like for a house that's a really competitive offer situation. But in a normal market, which hopefully one day, normal balanced market that we might get back to, then that would mean you would be doing all of those inspections that are listed there, which in today's market, we still also do. A general house inspection, a sewer scope, radon inspection. Sometimes you would do a structural if the general inspector brings up inspection issues that might be of structural nature. Hopefully that does not happen. As far as inspections go, you can expect to pay about, I would say, $500 to $800 for inspections. So in addition to your earnest money, this is money that you want to have up front and be able to write checks for. A general home inspection is probably around $400. A radon is another $100. And then a sewer scope is about $150. So that's when they send a camera down the line to check out the line and make sure that there aren't any issues. All really important things to do. and to make sure that the house is going to be sound for you and that you're not going to move in and incur a lot of additional expenses. Of course, if you're buying a fixer-upper type house, those are all things that you've taken into consideration and talked with your realtor about, and so that you know what you're getting into. At that point, once you've finished your inspections, then you've got a period where you can object, and we kind of renegotiate at that point. Or sometimes the seller says, no, I'm not doing anything. And then you as a buyer will decide if you want to stay in the contract or terminate it. And if you terminate it, you do get your earnest money back. And then if you stay in and we negotiate the inspection and everybody's in agreement, then we move on to the appraisal. The appraisal is scheduled by your bank or your financial institution, whoever you're doing your loan with. And the appraiser comes out and makes sure that the value is there for the bank. So we don't have much control over who that appraiser is. We don't have any control as the buyer. They go out and they appraise the property. They do have your contract in hand, so they know what you're paying, and typically the house does appraise for purchase price. They look at comparables within the neighborhood to be able to price that house in accordance to what has recently sold. Now, with our very fast moving market, when you're buying in the springtime, the comparables haven't yet caught up to the market. So appraisals can be an issue. And sometimes when we're writing offers nowadays, we're looking at different ways to make up appraisal gaps. And those are things that I can give you guys more information on, but it kind of goes beyond the scope of this discussion. So if the house doesn't appraise in a more balanced market, we sometimes negotiate for the seller to reduce the price. In this market, that might not be possible. So it's all dependent on where you're buying and which house and how long it's been on the market. And so there's just a lot of variables. At that point, if the house does appraise and we've gone through inspections, then we move on to final loan approval. And if you're pre-approved on the front end, the final loan approval is really simple, because if the house appraises and we have no issues, then the underwriter gives it their stamp of approval and we move on to closing. And we celebrate. And you get to move in, typically the day of closing, unless the house is occupied, and then that is negotiable. Sometimes it can take a couple of days, or sometimes the seller wants a rent back situation. So those are all negotiated at time of contract.
Thanks, Irene. We did receive a question, and it might be hard to answer, but because it depends on the property. But on average, how many offers is one property getting? What is the competition like?
That's a really good question. And it is dependent on the price point. The lower price points are getting a lot more offers, and also where the house is located. Our average price in Denver is $630 right now. So if you're looking at houses that are below that average price point, then there are more offers. I would say you're seeing anywhere from 3 on up in offers. My last listing in Valverde, which is a central Denver neighborhood, had 15 offers because it was listed at 365. It ended up going for 415. So that's not unusual. So that's why you really want to look in that lower, much lower than you're approved for. So hopefully that's not too discouraging, because, and like I said, as far as a buyer's market versus seller's market, we're in a very extreme seller's market right now. Typically right now you guys are in a better position, because June, July, August in normal times, not last year, not in COVID times, but in normal times, those 3 months are better, a little bit better for the buyers. So that doesn't mean that you'll be able to negotiate on the price. Right now, negotiating lower on the price doesn't really happen unless, for whatever reason, the contract has fallen out on the house and it's come back on the market, or it's been sitting, which is unlikely, then you can negotiate on the price, but typically you're going up in the price. But in these months, that can happen, where you get less offers on a property. So it's a little bit to the buyer's advantage. So hopefully that gives you guys a little bit of hope and doesn't discourage. So closing day, you're almost done. We'll meet at the title company. You sign all the papers together. The money is transferred on that day. You'll be bringing your down payment. Your bank will be bringing the loan proceeds. And then typically you do get possession same day, especially if the house is vacant. If it's not, then it would be negotiated per the contract. Sometimes sellers move out that day. Sometimes they may take a couple days, or sometimes they want a rent back, 30 to 60-day rent back. And depending on the house and, if your willingness to do that, sometimes buyers are giving sellers that kind of rent back situation for free, or they're negotiating it to cover their mortgage for those days. So that's closing day. What's next, Sarah? Oh, yes. So this slide just shows you what the average price is and what it's gone up. So we've had double-digit appreciations since about 2013, since we started really ramping up into our sellers market. 4 days median on market. Attached prices are less. So if you're a first-time home buyer, it's might be an opportunity to buy a condo or something attached, like a townhome. Those prices are less. They don't go up in value as much as a single family home does, but it's still a great way to get into the market.
Thanks, Irene.
Problem. I know might be like drinking out of a fire hose. There's a lot there.
Yeah, there's a lot of information, and we really appreciate you breaking it down and sharing your expertise. So some other resources that you can access before we send out that resource email and guide are that you can schedule a free one-on-one financial coaching session if you want help goal setting or talking through any of these things that we've discussed, like credit, budgeting, saving. We're happy to meet with you. We also have those e-learning courses in English or Spanish that are available on our website that cover a lot of the same topics. So credit scores, building savings, mortgages, home buying. This is what our e-courses look like. So they're animated, on demand, they're short, 5 to 7 minutes long, so you can access them anytime that works for you from your mobile device or laptop. Any other questions that you might have for our realtor Irene or for myself? Please place them in the chat.
And I can hang out if anybody wants to unmute themselves, and I'm happy to answer specific questions or anything like that too. Thanks for putting this on, Sarah. I think it's really important for people to start thinking about this. It looks like you had a really good turnout here, 25 people.
Yeah, thank you. Thanks for joining us.